Hello everyone and welcome to the continuation of my IFRS 12 tax accounting course. In this video I will continue with current tax. You'll recall that in my prior video I started talking about current tax and I must have mentioned that current tax is one of the two elements of income tax. So the first bit is clearly current tax and the second is deferred tax. And the last video I ran through the key principles of current tax, and I went through a couple of examples to illustrate those principles. And so what we're going to do today is to run through a case study to help us see how current tax provision works in practice. So when I mean in practice, I'm saying that what the companies do when they prepare their current tax provisions, what process do they go through, what working papers do they typically use. That's what we're going to try to do today. So it's going to be a basic example similar to one of those that I showed us in the last video, but now is being a lot more practical, working with the Excel working papers, so we see what it looks like in reality. And that's the case study you've got on your screen. And the case study talks about a company called Ewing Oil PLC. And so the financial controller of Ewing Oil PLC, which is a company based in Colombia Republic, has provided the unadjusted trial balance for the year ended 31 December to you. In this case, you being the tax reporting manager. The unadjusted trial balance shows a profit before tax of $5 million. And for tax purposes, as a tax manager, you have determined that the only material adjustment is a non-deductible expense of $400,000, which is related to a penalty for crude oil spillage. Your task as a tax reporting manager is to prepare the tax provision. But for now, we'll just focus on current tax for the year ended. And while you're preparing the tax provisions, we also need you to show all the relevant working papers and provide the tax adjusting journal entries to the financial controller. For note, saying that the tax rate in Colombia Republic is 20% and 2022 is the first year of operation. So this is the case study, and we'll shortly just go into spreadsheets to illustrate how this is done in practice. But before I go to the spreadsheets, I just want to quickly explain how this works in practice. So typically when a company needs to prepare its trial balance for the year, it will typically start with an unadjusted trial balance, which is a trial balance that does not include the tax provisions, the tax expenses in there, the tax balances are in there. And so that's the starting point. So the accounting team does that first, and they then provide those numbers. They provide the unadjusted trial balance, which is like a pre-tax trial balance, to the tax team, the tax accounting team. And the tax accounting team picks that unadjusted trial balance and prepares the tax provisions, going through all his working papers, and ultimately ends up with the tax adjusting journal entries, and which is a case of saying what the tax adjusting journal entries do is to summarize the tax entries you want the financial controller to post into the GL for the tax provisions for the year. You can make all your working papers, but you must go back to the accounting team to say these are the journals that I need you to post for tax purposes. Of course, you're going to have your working papers that backs up the journal entries, but the tax adjusting journal entry is the ultimate thing that the accounting team wants to see, and that's what we're going to try to show in today's video. And so what you see on my screen now is a spreadsheet that displays the key working papers that you will need to do your tax provision. So you're going to have a tax provision summary, you're going to have book to tax differences working paper, you're going to have the tax rate summary, you're going to have the current tax roll forward, then the tax journal entry summary. And this isn't really a working paper, it's like an extract of the trial balance. So as a starting point is the tax provision summary, and I must have shown you something similar to this in the prior videos, and it's a bit different though. Yeah, but I'll show you why it is similar. So the starting point in this case is your tax profit before tax for the year, which you will get from the unadjusted trial balance, and you're going to have certain adjustments. And those adjustments can be permanent differences or temporary differences. In a subsequent video, I'm going to talk about what these are. But for now, it's good enough to know that, I mean, the difference between your taxable, because what you have in your accounting books, your record is your profit before tax. But from a tax point of view, you don't have a profit before, you don't have an accounting profit, you have a taxable profit. And the differences between your accounting profit or your profit before tax and your taxable profit can either be a permanent difference or a temporary difference. So all those adjustments that we make can be permanent or temporary. I'm saying in the next video I will talk about what the permanent difference is, what the temporary difference is, and how to identify them. But I just thought I should just put them for now. Yeah, just know that they're this. But because in reality, when you do tax provisions, there are usually lots of permanent differences and lots of temporary differences. There's a separate working paper that analyzes what the PEMs are, permanent differences, and what the temporary differences are. And so which is what you can see on your screen. So you do all your detailed workings here, and you then transfer the summarized number into this working paper, which is like your tax provision summary. So again, we start with the profit before tax, and in the example, in the case study question, you'll remember that the profit before tax is 5 million USD, which I'm just typing here now. Yeah, that's the number you've got. And we know that there's an adjustment of a non-deductible expense of $400,000. Like I said, any of these adjustment needs to either be a permanent difference or a temporary difference. For now, I mean, it's a permanent difference, and I'm just going to type it in here. Oh, let me just put it back. $400,000. That's it. So for now, just appreciate that adjustment is a permanent difference. In a later video, I'll explain what the permanent difference is and what the temporary difference is. So we've put that number, and so I will just link it back from here, link it back to here, and there you go, it comes back here. So you see that if you look through the notes here, what I've tried to do is to, just provide comments where this number is coming from. Because in reality, when you do this workings, when you go through audits, the auditor may want to do some spot check to be able to see where your workings are coming from. Sometimes you don't want to provide your Excel workbook. It may just be PDFs, and then you see where these numbers are coming from. So once you put a note that says from book tax differences working paper, they can just go back here to go and check, the number is there. And that's for internal control point of view, or like preparing for auditors. Yeah, that's why it's important to put those notes. Again, here, if you look at the PBT, I'd mentioned that it's from the unadjusted trial balance. So anybody can go back to verify that it's actually from there. And to make life easy, there are no temporary differences, there are no other permanent differences. But in reality, you're going to have lots of all this. Yeah, and then you come down to taxable profit, which is essentially a sum of your PBT and all the adjustment, all your differences, your PEMs and your temps. In this case, we've just got one PEM, and we have no temps. So just put 0 there, and 0 here. And taxable profits, which is just taxable profit in this case before losses, is 5.4 million, which is a sum of everything you have above 5 million and 400,000. And you see, it's formula driven. It's adding everything up there together. And tax rates, if you remember from the case study, we had said that the tax rate is 20%. And if you go to the tax rate summary, you will see the 20% there, and you can see that it's based on the legislation. You may imagine where you have a separate working paper for tax rate summary, since it's just one number. Yeah, for a single entity company, you probably will not do this. But when you're preparing tax provisions for a large group that's got many entities in different countries, it can be difficult to track. And so what best practice is to have this separate working paper where you list all the entities and you list the tax rates that are applicable to each of the entities. Sometimes you're going to have multiple tax rates for each entity. Separate for deferred tax, separate for current tax, as the case may be. We'll talk about that at a much later point. But for now, if I'm saying it's best practice to have a separate working paper that talks about what the rate is, and it helps you to put notes to say this is where I've confirmed the rate, and somebody can check. And in reality, what you even do in practice, you even get a screenshot of this legislation that talks about what the rate, and you can just put it within the file. And so anybody who audits your work can say, yeah, okay, 20% is correct. And that's fine. I can see the basis immediately. And this is the need for somebody raising queries on the work you have done. And so all I just need to do here is to link this to rates here, and this is already formula driven. So the current tax for the the current tax here before any tax credits is clearly your tax rate of 20% multiplied by the taxable profit of 5.4 million, and that gives you 1.08 million. We don't have any tax credits here, so it's just 0. The number is 0. And so it means the current tax, even after tax credit, because that's 0, is still 1.08 million USD. In a typical provision, you will have certain adjustment like return to provisions true ups. You have other kinds of true ups, but in this case they are all 0. Yeah, but the point here, what I've tried to illustrate is to see what a full picture typically looks like. What kind of elements you typically see, and that's what I've just made it all this way. But I mean, the numbers we don't need it, the lines we don't need it. I've just put 0 on those lines. But I mean, this is the whole idea of how your tax provision summary working paper should look like. And I mean, you can take a screenshot of this and go and prepare it on your own if you need it for the work that you do. So that's about it. So you can see that we've got a current tax provision for the year of 1.08 million. So the next thing you need to prepare is the current tax roll forward. So what the number you have here, 1.08 million, is the current tax expense for the period. So for this year ended 31, how much am I putting into my P&L as the current tax for the period is 1.08 million, which is 20% of the taxable profit of the year. Yeah, but that's just one part of the question. You really answered the P&L part of the question. So what's going to be your balance sheet for the year? What's your closing balance for the period? And that's what the go forward working paper does for you. And it's simple. You will remember from the previous illustration I've done, we've done something similar before. You started with your opening balance. You're going to add your expense for the period. You're going to account for any payments you have made in the year, and there may be there may be certain true ups. Yeah, but for now, all those ones will be 0. We don't have them in this period. If you remember from the example from the case study question, this company started business in 2022, and this account is for the 2022 year. So it means that there was no day they would have owed any tax in the beginning of the year. So your opening balance is 0. The current tax expense here is coming from okay, I'll come back to explain where this is coming from. Yeah, so no, I think I can change that. It probably needs to just come straight from the tax provisions. Let's come straight from the tax provisions working paper, tax provision summary. Yeah, I think that makes a lot more sense. And the question doesn't say there are payments, so we assume there are no payments. But if there are payments, you would have had to confirm the payment for maybe the treasury team or maybe account payable that have done the payment. And so that's based on confirmation. Yeah, and in practice, you maybe won't even get, the spoil of the GL where the payment was posted into, and just, take a screenshot and put it here and all that. Or maybe an email confirmation of how much has been paid, and you just put it here and put a snip within the working paper. Then your true ups here, no true ups, no RTPs, true ups, no new RTPs in the year. There are no other adjustment. And so what it means is that we started with an expense. There was no liability or no asset at the beginning of the year. We just had an expense of 1.08 million during the year. Nothing has happened during the year. It means that our closing balance is still 1.08. Yeah, we didn't owe anything in the beginning. During the year, we say we now have a new tax expense of 1.08. We have not paid any portion of it, so it's still the liability for the period. And the double entry will be simple. You're going to be debiting your P&L with an expense of 1.08, and you're crediting your balance sheets with the liability of 1.08. So those are the key working papers really. And I need to take this out. Doesn't make sense here. Then we then go to the tax journal entries. So what entries do we want to post? What are we posting? We're saying to ourselves that in the trial balance, in the unadjusted trial balance that's the financial controller provided, there wasn't current tax expense there, there wasn't current tax liability there. So what we need to do is to say what have we calculated? We've calculated we have an expense of 1.08. We've calculated that we have a liability of 1.08, and we're saying to accounting team to say you had nothing before, yeah, and that's fine, but this is what we think you should have, 1.08. And column D is to say that okay, the difference between what you should be posting, what you should have in your books, and what you already have, which is 0, is what needs to go to column D. So column D is column C. D is essentially column C minus B. B is what you already have. C is what you should have. And D is the adjustment you need to make to get to what you should have. Yeah. I mean, in most likely, column P will be 0, but sometimes you're doing quarterly. I mean, you do provisions in a quarterly basis, and this is year end. So certain amounts were booked in Q1, certain amounts were booked in Q2, certain amounts were booked in Q3. And so in those kind of cases, you will already have numbers even within the unadjusted trial balance. And so when you calculate your tax plug for the year, what's the expense for the full year, you have the number here, and the adjustment entry will be what they need to be ready for the full year and what they already have within the books. Yeah, but we're just doing the full year provisions. Then we've assumed that there are no quarterly provisions that have been made before now, and that's why the unadjusted is 0. And so it gives you your tax AJE. I mean, accountants will be familiar with these terminologies. AJE is adjusting journal entry, but in this case, it's related to tax, and so you just call it tax AJE. And this is entry. This is what you ultimately give to accounting team. This is your deliverable to the accounting team. I mean, a typical tax journal entry summary will be much longer than this. You've got for current tax, P&L, the balance sheet, deferred tax P&L and balance sheet, and yeah, if you have multiple entities, you may have more than it. But it will usually be all those 4 categories of entries that you're going to give to the accounting team, and they'll probably ask you for your working papers that want to just verify, and that's it. This should always be 0. It should always nail up to 0, because I mean that's double entry. Your debit and credit should equal each other, and that's what I'm saying. You have this check to be sure that it nails up to 0. And so this is your final deliverable. And what happens is that once you give this to the accounting team, then they go into the trial balance. So in your trial balance, they will have the unadjusted column, and say, yeah, these are the AJEs that we've received from different teams. In this case, we're just looking at tax, and they will post this AJE, and they will have a final trial balance. So yes, this is what the final trial balance is. I mean, if you see a standard trial balance, in basic form, in the simplest of form, it will look like this: unadjusted, the AJEs, and the sum of the two of them gives you the final trial balance. And ultimately, this is what you get, and then go ahead and prepare the financial statements, and provides your auditors to do their work. Yeah. So this is about it for this video, and I think we've pretty much come to the end of current tax. So in the next video, what I'm going to try to do is to talk about booked tax differences, and that takes me to talking about permanent differences and temporary differences, because understanding this part gives a solid foundation to proceed to talk about deferred tax, where we're going to spend lots of time, lots of video to go through deferred tax. So I'll say thank you so much for listening, for following this video, and I'll say look forward to the next video. Take care. Bye bye.